Hi, this is Brian J. Decker with a quick bite on long-term care. I want to cover just a couple of pieces of information on long-term care, and I want to start with an interesting statistic. The long-term care industry says that 70% of Americans will spend time in a long-term care facility, but the U.S. Census number is 14%. How do you reconcile that? Well, the long-term care industry counts as being in a facility even if you spend one day in hospice. That's how they get those numbers up to 70%. So what we have found in the 35 years that I've been doing this, what we found is a sad second statistic is that if you need long-term care, you probably can't afford it. And if you don't need long-term care, you probably could afford it. So let me explain. Instead of looking at the situation all kinds of different ways, what we do is we run a test. Let's hope for the best and plan for the worst. So let's say that you and your spouse, the risk of long-term care is the risk of one spouse bankrupting another spouse due to high health care costs. So let's say a worst case scenario is that your spouse has been diagnosed with Alzheimer's or dementia, and that spouse is healthy as a horse. That combination of good health and dementia or Alzheimer's is the biggest financial drain on an estate. So let's assume that that's the case. In taking you through this timeline, the first third doesn't cost anything, typically. Emotionally it does, financially it doesn't. The spouse is taking care of the other spouse for the first third of the journey. The second third of this journey is where the spouse can no longer handle everything, so you bring in daily care, which can start at $1,500 and grow from there $3,000, $4,000, $5,000 a month. Depending on how much is needed. And that's the second third. In-home care is the second third of this journey. The third third is when your spouse is dressing up shirt and tie, wandering out in the neighborhoods, looking for their meeting that they insist that they need to go to, and they're endangering themselves. And so they need to check into a long-term care facility, and they're very expensive. Depending on where you live, they're $7,000 to $10,000 a month. Typically, sadly, there's about 2 years left on this journey. So 2 years times even $10,000, $250,000 would be the cost. Do you have $250,000? Most people have it in two places. One is in what we call their risk bucket. That creates extra funds to cover those costs. And the second, we view the home, the residence, as sacred. We keep it off balance sheet. We don't put it on your income plan. But if you had to, in an emergency, pull equity from your home to pay those bills, most people have it. But let's explore, that, by the way, is the self-finance route. And most of our clients at Decker Retirement Planning go that route. But what are your other options? If you have long-term care, traditional long-term care, we want to give you a heads up. By the way, this is by far the most popular other option to finance long-term care. If you are under 65 years old, you get a reasonable price for your long-term care costs. And your costs for long-term care are called, they have an interesting term for it. They call it a guaranteed level premium. Is it guaranteed level? No, it's not guaranteed level. In fact, in your late 60s, early 70s, you get something called the letter. And the letter informs you that your premium has just gone up 60%. Why 60%? Because that's the max allowed in your state. And the state insurance company allows cost recovery. So they allow this to come through. And you panic and you do one of three things. One is you cancel altogether and the insurance company wins. They've kept all those premiums and now they have zero risk. Or number two, you cut the premium benefit in half. That way the insurance company wins also because they now are getting the same amount of money for half the risk. Or your third option is to leave it alone. If our clients have long-term care coverage, then we leave it in place and we plan around it. But we want to make sure that you know it's not a surprise that that cost hike is coming. Other options that you have, we want to make sure that you know that if you get hit by a bus and you die, you don't collect any benefit from a long-term care insurance policy because you died, you never checked into a long-term care facility. So what some insurance people will say is that you need to get whole life with a long-term care rider. Let's say it's $300,000, and that way you can collect on that $300,000 no matter what, whether you die or whether you go into a facility or a combination of both. It sounds really good on the chalkboard. In reality, it's priced very expensively. In your early 60s, typically it's $1,000 a month, and price that out times 300 months. They plan on making sure that that's a profitable situation for them on the insurance company. So we want to make sure that you know that, heads up, that that's very expensive. Another one is, and I've saved the best for last, another one is called a safe harbor policy, a safe harbor trust. So in a safe harbor trust, you have the great idea of saying, if I get sick, I want to make sure I transfer all my assets over to my brother Brad. It doesn't cost me anything, and after I die, then all the assets transfer back and my spouse is in good shape. That's called a safe harbor trust. Two problems with it. One, the IRS is on top of this, and if you're diagnosed with Alzheimer's or dementia or anything that ultimately takes your life within 5 years of transferring assets, they have a clawback provision that brings all that back. The second problem is the bigger problem. My brother Brad can call me from Cabo after I transfer the assets and say, "Hey, Brian, I've decided to keep your assets." And legally he can because I signed them over. So not a good idea. We want to warn you against all of those. So this is just a quick, short piece of information that we wanted to cover on long-term care, and I hope it gives you more information on why we at Decker Retirement Planning have found, sadly, that if you need long-term care, you typically can't afford it. And if you don't need long-term care, you typically can, which is why most of our clients can self-insure.